Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klein and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this interview from November 2023, we speak with Matt Whineray, the then CEO of New Zealand Super, to celebrate the fund's 20th anniversary. Established in 2003 with an initial contribution of 2.4 billion New Zealand dollars, the fund has achieved an impressive average annual return rate of 9.5% over this 20-year period, adding 40 billion New Zealand dollars in value. We delve deep into the fund's strategic tilting program, which has been a significant contributor to its success. And this interview contains the startling admission that New Zealand Super once held a short position on the New Zealand dollar that grew to 40% of the net asset value of the fund.
We increased the short position in the Kiwi and it got very large, like up to nearly 40% of the NAV of the fund. And that starts to create nervousness because to get to that short position as the Kiwi continues to go up, we're losing money each day on what we had put on yesterday. And so that really focused the mind of the board and of the investment committee and of the tilting team and everybody on that position. But we saw in the end that the Kiwi reverted. So this is ultimately a mean reversion strategy. We expect things to revert to that long run equilibrium at some point. There'll obviously always be volatility, but it did, and so we got through that. But that was a real moment of tension.
Welcome to the i3 podcast. I'm here today with Matt Whineray, who is the Chief Executive Officer of New Zealand Super. And today we're celebrating 20 years of the fund. Matt, congratulations on this milestone.
Oh, thank you very much, and thanks for having me.
Excellent. So there's a couple of dates that we can take for this 20 years. I think the New Zealand Superannuation and Retirement Income Act was passed in 2001. And that set up the structure of what is now New Zealand Super. But it wasn't until 2003 that the fund received its first contribution, which I thought was 2.4 billion New Zealand dollars, and started investing later that year. So it's actually in, I think, October this year that we have a 20-year track record of the fund. Is that right? And can you share some of the learnings from that period?
That is right, yes. So it took a bit of work between the passing of the legislation in 2001 and kicking off. So getting the team together, and those board and those first few people that were involved. That's right. We got the money on 30 September 2003. I understand it. Actually, we invested almost straight away, some of it anyway, and had got set up to be ready to do that. So yeah, it's been a big moment for us, ticking over 20 years, and an opportunity at that point to sort of reflect on how we've changed since then, and we've changed quite significantly, but also what we've learned. So from a lesson perspective, I guess probably the most important ones are get the long-term risk setting right, understand how you think that might perform along the way, and then spend as much time as possible making sure that the stakeholders understand that, and so why you've done that and how it might operate. As an investor, we think about as a long horizon investor, we think about our key risks as being two big ones: liquidity, so running out of liquidity is pretty terminal, and stakeholder support. And so we spend a lot of time thinking about how we manage those in order to be able to get to the long term. Because if you're a long horizon investor, you care about what the return is over the long term. But if you cannot survive the journey, the destination doesn't matter. So we think hard about those. And one of the other critical foundational things that we've done is being really clear about what our advantages are as an investor. So we call these endowments. We don't have a lot of advantages, but they are important. So things like long horizon, our operational independence, our governance, our strong governance model, and our sovereign status are all critical. And aligning our investment strategy with those endowments and with really clear investment beliefs is really important as well. So those are sort of the big things that we've learned along the way. We certainly didn't know them all at the start, and we found out as we've gone along.
New Zealand Super always has a strong focus on governance, but of course we also would like to know the numbers. Have you crunched the numbers for the 20-year track record?
Yeah, we're about 9.5% per annum over that 20 years, and I guess most critically, from a national perspective, the country is more than $40 billion better off as a result of the creation of the super fund. So if you think about the alternative use of the contributions we have received would have been to pay down government debt. We have beaten that benchmark by more than $40 billion. And within that 40 billion, we've also added about $16 billion of value over our risk equivalent benchmark, our reference portfolio, which we'll get onto later on. But so we're very happy with how those numbers have turned out.
Excellent. Of course, governance is really important, but when we look at sort of the investment approach, can you tell us a little bit about the early days in terms of the asset classes that the fund started with and how that has evolved over time?
Sure. So in our right at the outset, we were a pretty traditional SAA approach. We had in that global equities, New Zealand equities as a separate asset class, and global was both developed and emerging markets, global fixed income, and then we also had a reasonably significant allocation to private market assets. So those were in those days private equity, timber, infrastructure, property. When I turned up in 2008, we had this other category that was called other private markets, which was kind of whatever else we found that was kind of interesting. And so we had a pretty big allocation to that private markets in that early SAA. But I think right from the outset, we've had a pretty growth-oriented portfolio. So it might have started at about sort of 70-30, moved to 80-20, and then our reference portfolio has been 80-20 since we implemented that, which was about 7 years into our operation. So we've always sought to take advantage of our long horizon and our relative lower need for liquidity and allocate it across those broad range of asset classes.
Yeah, is that why the fund started relatively early investing in private equity? Because I think I looked it up and it was only 2 years after the fund started investing that the first private equity investment was already made.
Yeah, so we had some small private equity fund of funds earlier on and some secondary fund and a more traditional GP commitment. That was part of that SAA allocation. So we, as a result of that original construct of the SAA, the team was focused on private markets. That allocation to private markets was about 35% in the early versions of the SAA. So a pretty chunky one. And so the team got on with thinking about how we could gain that exposure.
So what was the inspiration for that? Was that sort of, a lot of the Australian funds look at the Canadian peers and they obviously have a very heavy allocation to private assets, or was it more that long-term investment horizon?
Well, it was definitely a long-term investment horizon, but I think early on some of the people or investment people in the organisation certainly also looked at not just the Canadian peers, but also some of the US endowment models as well, which had significant exposure to private equity in particular. And I think right at the outset as well, we were entirely outsourced. When we kicked off, we're obviously using external managers, and that was the approach that was taken to get exposure to some of those different asset classes that were included in the SAA.
I think one of the things that really sets New Zealand Super apart is the strategic tilting program. That is not something that you see, especially not at the scale that I think New Zealand Super has implemented it. Can you tell me a little bit about, the philosophy behind it and why it was chosen to implement that? Because I think it first started in 2009, so about 6 years after the fund first started investing, which was relatively quick.
Yes.
Tell me a little bit about the philosophy.
Sure. So the strategic tilting came out of a lot of work done by our asset allocation team under the leadership of Neil Williams. So Neil had been in the asset allocation team at UBS Asset Management and worked with a couple of other guys, a guy called Brian Singer and Renato Staub there. And he had brought with him this thinking around a dynamic asset allocation approach. And the idea of it for us was to take advantage of our belief that we can have a more constant relative risk aversion than the market. So as the market gets excited or the market gets depressed, and if we have a long run view of the equilibrium value of a particular asset class, then as it gets depressed, we can add exposure, or as it gets excited, we can reduce exposure, and do that in a systematic way. So what we're trying to do is remove our own behavioral biases by creating a systematic, dynamic asset allocation approach. So the team did a lot of work on setting that up, thinking about what the governance of it ought to be. How do we make it efficient? How do we remove our personal biases as markets get really, volatile, and overcome that to be systematic in that? So it's not about waiting for a market to get to an extreme and then putting a position on. It's saying, hey, if the market's gone down and there's a gap between what we think value is and prices, then we will add exposure and we'll be systematic about how we size that. Then if it goes down the following day, then we'll add some more. If it goes down the next day, then we'll add some more. But what's happened in that moment is that the last 2 days are now worth less. So we've got a mark-to-market P&L loss. So it took quite a bit of work with the investment committee and also with the board to approve that strategy, because the darkest hour in that one is right before the dawn. As you get further and further away from fair value and you've increased your position either in a long way or in a short way, your mark-to-market loss will be at its peak at the moment at the moment where you forward looking have the highest expectation in terms of return. So it takes a lot of work to be able to hold on to that. You have to size it right to start with, so that you avoid two things. There's two really important things with tilting strategy. One is you don't lose your bottle at the wrong time, and that's really critical, because as soon as you've stopped out, you've lost that and there's no hope of getting it back. The other is getting your sizing right so that you've got a reasonable allocation of risk through the sort of different VP gaps. And because the worst thing is to have used all your risk while the market is just being volatile beyond where you got your positions on. So that took quite a bit of work to get all that done, but we kicked that off in March 2009. And frankly, that was a good time to do it, because if you draw the graph, that is the low point of the equity market. So we were very fortunate in terms of kicking it off there. It was interesting because we had said to the board, look, we may be out of the money for a long period of time here, and we'll all have to, hold hands and make sure that works. And then what happened was we put some positions on and the market immediately went off, and the board said, oh, well, that was easy. Why don't you do some more?
Yeah. And from memory, I think one of the ways to sort of get the board along with this program was that you had specific people on the board that were sort of selected to go in sort of a deep dive into this program, so that they almost became spokespeople for this program on the board itself. How has that developed over the years? Did it, once you had that initial success, did they immediately become much more comfortable with it, or have questions been raised during the years whether we should continue this?
Yeah, look, I think it's, as boards change in terms of personnel, it's always important to keep them up to date with what the genesis of a particular strategy was and what the basis for it is and how it connects with our endowments or our investment beliefs. It certainly has taken a lot of time for us, keeping the board refreshed on how the thing works and how we expect it to work, and why in a model where once a when a market hits a particular level, we buy some exposure, and then it goes down, and then it goes down, and then it starts coming back up. We will demonstrate that over time that should generate us a return. And so we've done a lot of work with the board on that. But absolutely, there are times when that will be tested. So if you fast forward to 2013, we had a time when the Kiwi dollar was very strong against, in particular the US, but other currencies as well. And what happened was, in those days, we had our tilting program was really the Kiwi against like the world basket of currencies. And so what happened was we increased the short position in the Kiwi, and it got very large, like up to nearly 40% of the NAV of the fund. And that starts to create nervousness, because to get to that short position as the Kiwi continues to go up, we're losing money each day on what we had put on yesterday. And so that really focused the mind of the board and of the investment committee and of the tilting team and everybody on that position. But we saw in the end that the Kiwi reverted. So this is ultimately a mean reversion strategy. We expect things to revert to that long run equilibrium at some point. There'll obviously always be volatility, but it did, and so we got through that. But that was a real moment of tension. And one that required, careful understanding of the basis for the strategy. Step away from the positions and the P&L and all that sort of stuff. Go back and say, well, has the basis for the strategy, does that still exist? Do we still believe in some long run value? Do we still believe in mean reversion? And then if we've sized it correctly, then we can survive it. So that's the key with these types of things, is over time, we have increased the active risk allocated to that. We doubled it a couple of times from the outset. But you always need to make sure that you size a strategy. I pinched this one from Cliff Asness. Don't size a strategy so that if it goes wrong, you're dead, because that's pretty fundamental. And so that's how we've thought about that. Get the sizing of the active risk budget right.
Yeah, for sure. Because I think we spoke in 2019, just after Willis Towers Watson did a review of the fund, and they brought this up. They basically said the tilting program is quite unique, and perhaps the board should look at it and reconfirm whether they're comfortable with the amount of risk budget it takes up. And I think New Zealand Super did that, and they said, yes, we are comfortable with that. Did that sort of 2013 experience help with formulating the thoughts around that query of Willis Towers Watson, where you basically, because you went through that exercise and got into a situation where it was quite uncomfortable, I suppose, to hold that position, that it was then easier to state that you were comfortable with it a number of years later?
Yeah, so a few things that happened. The team continues to develop that tilting strategy, and some things that happened. So very early on, if you go right back to the start of it, we just had sort of two levers. One was equities versus bonds, and we tilt that, and Kiwi versus all the other currencies, the trade weighted index. And so it was a pretty narrow strategy. And what the team always had intended to have happen was to increase the breadth of that strategy. So particularly in the currency side of things, we went from that Kiwi versus the basket to 9 different currencies that we could tilt against each other. And so that was a really important change in the breadth of the strategy. Now, that helped us a lot, because then you reduce the amount of risk you've got on sort of one particular view of the equilibrium view of two currencies, of a pair of currencies. And so I think all of that work helped when we came to that conversation with the board following the Willis Towers Watson report, to be able to say, well, this is how we think about this. Because at the same time as doing that, we'd expanded the equity bond one to be, I think we've got 9 markets in both of those now, and we tilt equities versus cash and bonds versus cash and bonds versus equity. So there's a bit more breadth in that as well, and that gave us a bit more comfort. So, and funnily enough, what that meant is that our actual risk budget went down a little bit because we ended up with a few more positions that were not perfectly correlated with each other. So all of that helped when it came to that discussion with the board to say, are we still confident in this? Because the amount of risk that we allocate to the tilting strategy is definitely the highest amount of any of our internal strategies. But there is a lot of breadth in there across the different types of tilting asset class. But it also reflects our confidence in the strategy and critically its alignment with our endowments and our beliefs. So that's why it gets more risk, and that risk has turned out to be rewarded for us. So we've been very pleased with that.
Yeah, and I think in recent years it has also been expanded. I think commodities was added as one of the levers. Can you tell me a little bit about that and what is sort of the plans going forward for this program?
Yeah, so we've got commodities in there as well as REITs. So we sort of took REITs out of the equities and thought about whether they might provide us with a different exposure or a way of expressing views in a way that wasn't perfectly correlated with the other markets that we're doing. So we added commodities in a pretty small way. Commodities is a bit trickier because you've got both levels and curves, and so there's sort of more variables, if you like. So really the addition of that is a way of us learning a bit more about those markets. It has a very small amount of active risk associated with it at the moment, and the team are looking to learn a bit more about how our models work in that situation, our confidence in our models, because in all of these different markets, we have a differential level of confidence in, our view of equilibrium or our view of how it might track over time. And as a result of that sort of explicit level of confidence, that will affect how much risk we allocate to it. So what the team's looking to do is thinking about, well, are there other ways we could express this strategy? Are there different signals we might use? How do we think about trading, not necessarily frequency, but size positions? This thing has evolved. In the very early days, we just did it. We traded it once a month. Now the team trades it every day and sometimes a couple of times a day, depending on which markets are open. So the team continues to develop that to look for, again, more breadth and ways that we can take advantage of our endowments in terms of that long horizon and as I say, a belief in that slightly more constant relative risk aversion.
And how do you keep the costs under control if you trade multiple times a day?
Yeah, so that's a debate that the team has every so often, which is how do you think about that trade-off between position sizes and transaction costs? We keep the costs under control by executing all of the trades ourselves. So our portfolio completion team does those trades. We trade predominantly in futures. Sometimes there's some swaps, but mostly it's futures. And yeah, there's an active discussion about how do we make sure we've got the trade-off right between position size, change, and transaction costs.
Now, this program was in place before New Zealand Super embraced the reference portfolio.
Yeah.
And I think that came in about 2010. So the fund had already been operational or at least investing for at least 7 years. Why that switch at that time? What was the thinking behind introducing this reference portfolio?
Yeah, so we'd been looking at some of the work that had come out of Canada and thinking about that reference portfolio approach. And in those days, it wasn't actually, I don't think it was called total portfolio approach. That's sort of been coined later. But one of our firm beliefs is that you should have some real clarity about whose decision is whose. So let's be clear about who's making the big decision about the risk tolerance, which is obviously the board, what the active risk budget should be in terms of the implementation of that portfolio, and then be able to determine how those big decisions have panned out. One of the challenges with an SAA approach is it's impossible to fully replicate the SAA. You cannot ever be at the exact amount of the SAA, and so then you always have a little bit of a confusion about, well, are you there because you didn't want to be, or are you there because there's just it's not available? How do you think about those? What the beauty of the reference portfolio approach is that there is real clarity about the decisions that are being made. So you've got the big one, which is what's the composition of the reference portfolio, including the asset classes and the currency decision you're making, the hedging decision. Then the allocation of active risk to management in order to be able to manage that then says, okay, if we decide to invest in something, so let's buy a forest, we are going to sell some part of the reference portfolio. So we'll sell some equities and some bonds that match the risk. We can tell exactly how that decision panned out because we know what the funding proxy was, and we know what the asset return is. So it's very clear that when we make those decisions, we can determine how they went. So there's this sort of that clarity of responsibility of decision and accountability for outcome is we thought was important. But it also helped with our team to be able to say, we're not here to just, if we've got 10% allocated to this private market asset class, call it timber or infrastructure, we're not just here to fill that up. We need to only put assets into that opportunity if they're actually going to improve the outcomes for the total portfolio. And so the idea of trying to get the team to think more clearly about what is it we're selling in order to buy this thing, what is the relative attractiveness of a forest versus some private equity commitment versus some property development, and how do we get them to think about that? The reference portfolio really helps with underpinning that total portfolio approach. And so there was quite a lot of work went into that before we implemented it or agreed it with the board and then implemented it in 2010.
And I think the reference portfolio has changed over the years a couple of times. I can remember an instance where emerging markets was part of it, and then that was taken out again. And there was an argument made for a more simple reference portfolio. Can you tell me a little bit about that evolution?
Yeah, so some things have come and gone. I mean, emerging markets has always been in there, but it's been in there. Sometimes it was broken out, so we had global developed markets and global emerging markets with separate weights, and then we said, oh well, let's just take the MSCI, ACWI, and that has dynamic weight, if you like, between the emerging markets and the developed markets. So it's always been in there, but it has been expressed differently. The other things that have been in there, so we've always had some New Zealand equities in there. Earlier on, we had a bigger, when the fund was smaller, we had a bigger proportion of New Zealand listed equities in the portfolio. That's now 5%, which is still pretty chunky for a portfolio of our size. We had some listed real estate in there for a while in the portfolio. So still actually in our annual report, you'll see in some of the really longer term returns, you'll see a reference to real estate in a reference portfolio calculation of performance. So that's because that was in there at some point. So we've stuck to the idea that it is a simple notional passive portfolio. So global equities, New Zealand equities, and global fixed income, and then this decision on how much we hedge it. And so the decision since inception has been that we hedge the whole portfolio 100% back to New Zealand dollars, and that's one that we always debate at a reference portfolio reset. Yeah.
So how close is the current portfolio to the reference portfolio?
Oh, it's quite different to the reference portfolio. So there'd be 30-something% illiquids or unlisted assets in there and various different strategies. So yeah, a reasonable difference from the reference portfolio. We have an active risk budget from the board of 4%, expressed as a tracking error at the whole fund level, and that's quite a bit of rope for us to sort of depart from the reference portfolio with the objective of beating the reference portfolio, and we have been able to do that through those various strategies, including that strategic tilting one. So so there's a reasonable difference from the reference portfolio, and really what the reference portfolio is doing is setting that long-term risk appetite, and then giving management the leeway to go and deliver that in a way using that active risk, which ought to beat that on a risk adjusted basis. So while we're taking active risk, any position that we add to the portfolio, we're going to sell something that keeps the total risk constant. That's what the aim is.
Yeah. And you mentioned you have a reasonable chunky allocation to domestic equities, New Zealand equities. And I believe you manage them in-house. Is that right? And why was that decision made to bring that in-house?
Yeah, so actually we've just, in the last few weeks, we've just gone over 10 years of doing that. So we haven't always managed them in-house. Obviously, we had 10 years before we started doing that. But Why do we do that? So at the moment, we manage it in-house, but we also have 2 external managers of New Zealand active equities. Interestingly enough, it's really the only place that we have active listed equity exposure is in relation to our New Zealand piece. We have in our global equities, we have mostly passive, but we also have some factor mandates run by external managers. But in the domestic one is where we actually have sort of stock pickers, if you like. Why do we do it? Well, from the outset, as I said, we were entirely outsourced. We had a number of external New Zealand managers. We set up the internal New Zealand team because we're a significant presence in the New Zealand market, and we needed to have a way of properly engaging with that market, as opposed to just, we've appointed these 3 external managers and they're doing it for us. So if someone came and said to us, what's your view on this stock? We're like, well, we don't know, because we're not managing it on an active basis. So we needed really to step up our engagement with the domestic market and make sure that we were properly participating in those capital markets. But also because we held the view, and still do, that there is a positive expected alpha for the average New Zealand active manager, which maybe says more about the benchmark than it does about the managers, but nevertheless it's there. And so we thought that was something that we could do in-house, and over time that has proved to be the case. So that team has done really well over the 10 years it's been operating.
Yeah. Internalization is a big point of discussion as well here in Australia, where we have a number of funds that have gone down that route. They mainly do it for sort of capacity reasons as well as cost savings. Mm-hmm. From your perspective, you say you wanted to have a say in the market, have a form of view. Does that mean that this will be the only asset class that will be internalized, or are there plans to do that with other asset classes as well?
So there are a few reasons. There was that reason to be able to engage. It was never really a cost one for us, but it is a space that we thought that we could get the capability internally. And that's one of the big challenges with, internalization, is the assumption is that you will be able to get the people internally that you need to do it as effectively as those external managers that you might otherwise use. This is a place where we thought we would be able to do that. Capacity is an important one, though, too, because we had seen some change in our external managers in New Zealand over time. And so we ran a little bit of a risk that if we lost one of them, or if they fell below a conviction threshold for us and we took the mandate back, that it would be hard to replace that. So having an internal team we were able to have a bit of flex in how we manage those external mandates. In terms of that internalization, so what else do we do? We have a portfolio completion team that runs an internal credit mandate we call it the Tactical Credit Opportunities Mandate. So that does things which look to take advantage again of our endowments and also the strength of our balance sheet. So that's an internal function. We have a direct investment team where we make direct investment in unlisted assets, both in New Zealand and internationally. So that's something that we do alongside either external managers or other asset owners as partners. We operate obviously the tilting team internally, but we're not wholesale looking to internalize a lot of things. We've always thought about, why would we do something versus have somebody else do it? Yes, cost is a factor, but it's not really the key driver for us. We've thought about it as, is it a critical risk function? Is there something that we need to manage, a risk that we need to manage? So that's why we created that portfolio completion team originally. That is to manage liquidity. So at the GFC, we needed to know what liquidity we had and how much we needed. Well, that was all being done by individual managers externally, and we didn't have really a view of it because we had no market-facing team. So we created that. That's a risk management function, but has turned into a value-adding function. Or it's a place where you can't get alignment. And alignment is really what has driven tilting to be an internal strategy. It's very hard to get alignment with an external manager on that type of strategy because of the possibility that it is out of the money for an extensive period of time, and that causes agency issues with your external agents.
Yeah. Now, another topic that comes up a lot these days is decarbonization and climate change. And if we take a bit of a broader view, it comes down on the sustainable and sort of responsible investment. Now, I think New Zealand Super already implemented a responsible investment framework in 2006. That's, I think, a time when people were still looking very differently at this space. Where did that focus come from?
So in our legislation, we've got three bits to our mandate: maximise return without undue risk, use best practice portfolio management, and do it operate while avoiding prejudice to New Zealand's reputation as a responsible member of the world community. And so the original hook, if you like, for our responsible investment framework back in 2006 was that third one, avoid prejudice to New Zealand's reputation. What's been interesting over time as the world has evolved and the investment world has evolved is that those first two, maximise return without undue risk and best practice portfolio management, have both become increasingly important parts of responsible investment. We did a big piece of work a couple of years ago. We called our resetting the RI compass, resetting the responsible investment compass, and we looked at practices around the world and said, what is best practice portfolio management these days in relation to asset owners like ourselves? And in fact, what we discovered there is best practice is absolute integration of responsible investment considerations in investment decision making over the long term. So and then if you think about that maximise return without undue risk, that undue risk language became the key hook for our climate change investment strategy, because we thought, we're not getting paid for this, we're not compensated for that risk, it's therefore undue. So all of those bits have been important at different times to how we've evolved that responsible investment framework from 2006, when we created that and we were founding signatories of the UNPRI, to the RI Compass work, which has led to our sustainable finance strategy, and our climate change investment strategy, which has led us down the decarbonisation route in terms of the broader portfolio.
And I think New Zealand Super has also put itself as a guiding light for some of the regional funds in the Pacific. And I'm thinking especially on sort of there was a program where you basically invited them to co-invest with New Zealand Super in a private equity program. Can you tell us a little bit about how New Zealand Super looks at that position, trying to help out the funds in the region?
Yeah, so that one is sort of, from an asset owner perspective, there's no downside to us to helping our friends in the region, lift their capability and understanding of particular issues or strategies. And so we've been involved in the Pacific Island Investment Forum for a while. The fund that you referred to around co-investment was a domestic one where we've entered into a co-investment relationship with a private equity fund that we helped sponsor the establishment of, which is a number of different Māori tribes. So different iwi invest in that vehicle, and we have co-invested with that vehicle in domestic transactions. We've had great benefit from knowledge sharing with our big peers around the world. I think of the Canadian funds and the Swedish funds and the Singaporean funds, GIC and Temasek. And they've all been very generous in helping us. And there's a really nice dynamic there where asset owners will assist others because it doesn't hurt them, but it helps the overall system to lift the general capability. And so we feel that in relation to our domestic and also our broader Pacific cousins, and happy to help them too.
Yeah. If we look a little bit into the future, I think New Zealand Super at some stage will go in a drawdown mode. And I think the government has had plans to start drawing down on the fund in 2035, around that time. And that will mean that the fund will probably reach its peak size in 2070. How do you sort of prepare for that change?
Yeah, so the way our legislation works is it's got a formula in it, which was hats off to the people that drafted that, because it was a fantastic bit of drafting. Anyway, that formula is the way that it gives effect to the legislation's desire to have us smooth out the long-term cost of New Zealand national superannuation. And Treasury keep a model. They maintain the model of that formula, and they publish that on their website, so anyone can go and have a look at it. You just type in New Zealand super fund model, and you can open the Excel spreadsheet. You can change the assumptions. You can play around with it. If you're finding it hard to go to sleep, you can do that. But it is very interesting, and so that will change depending on what our returns have been, what the sort of forecast view of GDP growth is, what our long run returns are, that type of thing, or what contributions are. And so at the moment, what that model is saying, and that's updated once or twice a year by Treasury, is that in about 2035, we'll go from receiving contributions decline through to then, to start paying money back to the government to smooth out that cost. Those withdrawals, if you like, are relatively small to start with, and then by the time you get to about 2050, they're a bit chunkier. But the way the model works is that we will continue to grow in nominal terms. Our forecast expected returns are higher than both the tax leakage and the withdrawals. We will peak on the current modelling as a percentage of GDP about 2080, but we should continue to grow in nominal terms beyond that. So that's where that very long horizon comes from. So what does that mean for us? It means that there will be some change. We will start to see some liquidity draw in about 12 years' time. It won't be big to start with. And so something that we need to think about there is we'll have 3 more iterations of reference portfolio reviews before then, to think about what does that do to us in terms of our view. We'll have some liquidity requirements. We'll have to produce liquidity each year, obviously, to make those payments, and that may change our risk profile a little bit. So don't know what that looks like at the moment. That's going to be something for the team to work out over the next 12 years as we go through that. So we've got a 2025 reference portfolio review, then another one in 2030, and then another one based on the current scheduling. Anyway, we do that roughly every 5 years.
Yeah,
it'll be interesting to see how that changes our tolerance.
Now, another part of sort of looking into the future is there's a lot of talk these days about artificial intelligence with ChatGPT. And I was interested to see that in the annual report that came out over last year, there's a paragraph in there that New Zealand Super has been experimenting with sort of an AI portfolio. Can you tell us a little bit about that, or is that still in early stages?
No, I can talk about that. So it's more of a sort of machine learning portfolio. So what that portfolio is, it's a New Zealand equities portfolio, and one of the team has built a model to effectively construct a portfolio of New Zealand equities that maximises factors that we believe will be rewarded over subsequent periods, and then rerun that model on a regular basis and do the trades based on what the model is telling us. It's pretty small at the moment, so we've got I think the number at the moment is about $30 or $40 million allocated to that, but we are actually running the portfolio. It's different from running a notional one. We're actually saying, what's the impact of transaction costs? What's the impact of market spreads? The actual impact of running this, and we're watching it as it goes, and we're learning from that as we go. So it's quite a neat little project that quite a few people have been involved in internally, and it's giving us an alternative, if you like, an alternative access point for the New Zealand market. So we've got obviously our internal active, we've got this small machine learning portfolio, and then we've got a couple of external. So we've got different ways to access that local market, and also, but just to learn along the way. That's really what it's doing for us.
Yeah. So do you think that will become over time a substantial part of the portfolio, or is it more an experiment still?
Oh, it's still an experiment at the moment, but I expect if you get some comfort around how it operates, yes, that will be. I expect that probably even in some of the other work that we do around our currency hedging or our completion of the portfolio using derivatives, we might see some use of AI techniques in those as well from an optimization perspective.
Yeah. So the fund has had a good experience in the last 20 years. It's in a good position to tackle the next 20 years. But I believe that you're going to leave the position at the end of the year to have somebody else take it over after nearly 15 years with the fund. What's in store for you?
Well, I'm planning to go to the beach at the end of the year and stay there for a while. That's my plan. I haven't got anything. I'm not going to a role at the moment. So I'm really just looking forward to spending a bit of time on the beach and getting an opportunity to think about what might come next after, as you say, 15 years here and 5 years in the CEO role. But I'll be very interested in how the fund goes.
Yeah. Do you have any sort of favorite memories of that time?
Look, I arrived in May 2008, and so the world at that point, that was after Bear Stearns but before Lehman, and I was looking after private markets, and so that was a really interesting position to be in, to watch sort of observe what was then the credit crunch turn into the GFC and the carnage that ensued, and being in the private markets was a little bit. Private markets just are smoother as a result of only measuring them once a year. So it was a little bit less of a crisis than what was going on in public. But that was a great opportunity for me to learn. And then so right out of the blocks, I got some pretty good lessons in how to think about portfolio construction. We had a 10-year anniversary. We created a super fun ukulele orchestra. That was pretty awesome. That was 2013. 2016, we hosted the International Forum of Sovereign Wealth Funds here, and the most memorable bit about that is that the final dinner was the night when the presidential election was being reported, and so that had quite a big impact on that dinner. In fact, almost everyone at the International Forum of Sovereign Wealth Funds can remember that particular meeting in Auckland because of that moment. And then, look, I think the last few years have been interesting. Early 2020, I had a radio interview where I was telling the interviewer that we'd just gone from 48 billion to 35 billion, and as a result of that big drawdown in Feb, March 2020, and actually the ability to say that without the sky completely falling in was a testament to the work that we'd done about that sort of stakeholder management I talked about right at the start, educating people why we took the risk and what could happen along the way. Since then, obviously, the market rebounded, which was great. We're up to 65 billion. We've got about 200 people. When I started, we had 40, but there are still quite a few people from when I started who are still here, which is a testament to what a great place to work here is. And then most recently, the fund got named best performing sovereign wealth fund in the world for the last 10 years. So that was that was very exciting and a great recognition of the awesome work that the people here do.
Yeah, for sure. Yeah, I remember doing an interview a while ago with Bob Maynard, who was the CIO of a state pension fund in the US, the Idaho pension fund. And I asked him a question around, which other funds do you look at? And he said at that time, New Zealand Super, their returns are just magical. So, I think that's a testament to the great work you guys have done. So congratulations again on 20 years. It was great having a bit of a historical view on it and the development. So thank you very much for your time, and all the best in whatever new role you might end up in.
Well, thank you very much, Wada, and we've appreciated our relationship over the years with i3. You've had a lot of contact with the team here, and it's been a very helpful forum for us again to share the knowledge, because I think that is one of the great things about asset owners is this willingness to share, and I've been a great beneficiary of that, and so long may that continue.
Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3, -invest.com. And don't forget to like, subscribe and review. Thank you very much.